Most people think credit cards are free money. Swipe now, pay later, collect rewards, and move on. But that is exactly why credit cards are so powerful for banks. A credit card is not extra income. It is a short-term loan that feels painless in the moment. If you understand how it really works, it can be useful. If you do not, it can quietly become one of the most expensive financial traps in your life. At the most basic level, a credit card lets you borrow money from a bank or card company to make purchases today. Instead of your own money leaving your bank account instantly, the card issuer pays the merchant first. Then you owe that amount back to the issuer. So every time you use a credit card, there are really three parties involved: you, the merchant, and the card issuer. Each credit card comes with a credit limit. This is the maximum amount you are allowed to borrow at one time. If your credit limit is $5,000, it does not mean you have $5,000. It means the bank is willing to lend you up to that amount under the card's terms. The limit is based on factors like your income, credit history, existing debt, and the bank's own risk assessment. When you use the card, your balance goes up. At the end of the billing cycle, the bank creates a statement. This statement summarizes what you spent, what you already paid, and how much you now owe. It also shows a due date. If you pay the full statement balance by that due date, many cards will not charge you interest on those purchases. That short window is called the grace period. The grace period is one of the reasons credit cards can be useful. It gives you short-term convenience without cost, but only if you pay in full on time. The trouble begins when you do not. If you carry a balance, meaning you do not repay the full amount, the remaining balance can start collecting interest. And credit card interest rates are usually much higher than most other common forms of borrowing. Let's make this simple. Imagine you spent $1,000 on your card. When the bill arrives, you have two broad choices. First, you can pay the full $1,000 and keep things clean. Second, you can pay less than that. The card company will usually require a minimum payment, which may look small and manageable. But paying only the minimum is where many people fall into trouble. Why is the minimum payment so dangerous? Because it creates the illusion that everything is under control. You pay a small amount, avoid immediate default, and feel relieved. But most of the unpaid balance remains. Then interest is applied to that remaining amount. Over time, more of your future payments go toward interest instead of reducing the actual debt. That is why credit card debt can feel like running on a treadmill. This is also where the annual percentage rate, or APR, matters. APR is the yearly interest rate associated with the card. If a card has an APR of 25%, that does not mean the bank adds 25% once and moves on. Interest is typically calculated more frequently, and if you keep carrying a balance, the effect compounds over time. So what looked like manageable debt can become surprisingly expensive. Now let's talk about transactions. Credit cards are not all treated the same way. A normal purchase may get a grace period if you pay in full. But cash advances often do not. A cash advance means using the card to withdraw cash or do a similar transaction. These usually carry higher fees and interest may start immediately. That makes cash advances one of the most expensive ways to borrow money. Late payments create another layer of problems. If you miss your due date, you may have to pay a late fee. Your interest situation may also worsen, depending on the card terms. On top of that, repeated missed payments can damage your credit score. So one missed payment is not just a small mistake. It can trigger fees, more interest, and long-term consequences that affect future borrowing. Your credit score matters because it affects how lenders see you. It can influence whether you get approved for loans, what interest rate you receive, and sometimes even housing or service approvals. One important factor is credit utilization. That means how much of your available credit you are using. If your card limit is $5,000 and your balance is $4,000, your utilization is very high, which may hurt your score. A common guideline is to keep utilization relatively low, especially if you care about your credit profile. This does not mean you can never use your card heavily. It means that carrying high balances too often can make you look financially stretched. Even if you are paying eventually, a card that stays near the limit can send the wrong signal. This is why credit cards affect both your cash flow and your financial reputation. So if credit cards are risky, why do people use them? Because when used correctly, they can be convenient and useful. They can help you make secure digital payments, handle short-term spending smoothly, build credit history, and sometimes earn rewards such as cashback or travel points. But rewards only make sense if you avoid interest and fees. A 2% reward means very little if you are paying 25% interest. A simple rule can protect you from most credit card problems. Never treat your card limit like spending power. Treat your card like a payment tool, not a source of lifestyle inflation. In practice, that means only charging what you could afford to pay from your bank account. If you would not spend the cash today, you should be careful about putting it on the card just because the swipe feels easy. Another smart habit is automating your payments, especially the full statement balance if your cash flow allows it. Automation reduces the chance of forgetting a due date. If paying in full is not possible, at least avoid missing the minimum payment. But the real goal should be to stop carrying revolving debt. Credit cards are best when they are used regularly, paid fully, and kept under control rather than becoming a permanent monthly burden. If you already have credit card debt, the first step is clarity. List each card, its balance, its interest rate, and its minimum payment. Then decide on a payoff strategy. Two common approaches are the snowball method and the avalanche method. The snowball method focuses on clearing the smallest balance first for quick wins. The avalanche method focuses on the highest interest rate first to reduce total cost. You should also watch out for emotional triggers. Many people do not get into credit card trouble because they do not understand math. They get into trouble because credit cards make overspending feel invisible. Tapping a card does not feel the same as handing over cash. Stress, boredom, social pressure, and convenience can all push people to spend more than they planned. Financial discipline is often emotional before it is numerical. Used wisely, a credit card can be a tool. Used carelessly, it becomes a high-interest loan hiding inside everyday life. That is the key idea. The danger is not the plastic card itself. The danger is misunderstanding the system behind it. Once you understand limits, billing cycles, due dates, utilization, and interest, the product becomes far less mysterious. And when something is less mysterious, it becomes much easier to control. So here is the short version. A credit card lets you borrow money for purchases. If you pay the full statement balance on time, it can be convenient and even beneficial. If you carry balances, miss due dates, or live near the credit limit, it can become expensive very quickly. The card itself is not good or bad. Its impact depends almost entirely on how you use it. If you want to be financially strong, learn to use credit with respect, not fear and not overconfidence. Understand every due date, read the terms, track your balance, keep your utilization in check, and most importantly, remember that borrowed money always has a cost, even when that cost is temporarily hidden. Once you see how credit cards really work, you are far less likely to let them quietly work against you.